Welcome back to our Ultimate Lease Accounting series. In our previous video, we talked about why lease accounting had to change. Under ASC 840, only capital leases were recorded on the balance sheet. But now, under ASC 842, both finance and operating leases are on the balance sheet. During this video, I'll go into more detail on what exactly defines a lease, including how to tell if a contract contains a lease and how to uncover your embedded leases. Let's get started. The basic lease definition and what a lease represents, paying for the right to use assets owned by another party for a specified period of time, is still the same. However, ASC 842 places a new emphasis on the concepts of an identified asset and when the lessee has the right to control that asset. First is the concept of having an identified asset, which requires the consideration of whether or not the lessor has substantive substitution rights. This is a situation where the lessor has the unilateral right to switch out the leased asset for a different asset, and the benefit of doing so outweighs the cost. In order for the lessor to have substantive substitution rights, both of the following criteria must be met. 1, the supplier must have the practical ability to substitute an alternate asset throughout the period of use. And 2, the supplier must benefit economically by exercising that right to substitute. If the supplier has substantive substitution rights and the customer actually doesn't have the right to use the asset and the arrangement is not accounted for as a lease. Let's use a delivery truck as an example. If the agreement is for the supplier to provide a delivery truck, but the supplier is able to use any of the trucks in their fleet at their discretion, they have a right to substitute. One other point to note regarding identified assets in a lease, the asset can be identified either explicitly or implicitly. To make an explicit identification of an asset is to call it out specifically or specify what the asset is, perhaps with an identification number in the lease agreement or with details in an addendum to the lease agreement. Implicit identification occurs when the only way the supplier can satisfy their obligation under the contract is to utilize a specific asset. For instance, a lease may be for a specific type of vehicle. If the lessor only has one of those vehicles, in order to substitute its obligation under the contract, the supplier must then use that one vehicle. As a result, the asset is implicitly identified in the contract. Another concept we want to highlight is the emphasis ASC 842 places on control. A customer is considered to have the right to control an asset if 1, they have the right to obtain substantially all of the economic benefits from the asset, and 2, they can direct the use of that asset. Legacy lease accounting rules primarily focused on the economic benefit criteria, but ASC 842 now requires thinking through what purpose the asset is used for and which party controls those decisions. This is where judgment can come into play. The standard doesn't set a specific definition for substantially all. Some of the factors to consider when performing this analysis, though, include what is the purpose of the asset, and does the customer have the right to dictate when, how, or where that asset is used? A lease arrangement can be pretty clear-cut regarding control, but more analysis and thought may be needed, especially when identifying embedded leases. How to tell if a contract contains a lease. Think of a decision tree with multiple questions to determine if a lease is present. Is there an identified asset? Are there substitution rights? What about control? Does the lessee have the ability to both direct the use of the asset and retain the economic benefits? In our accounting guide, example 1 is whether a stadium naming rights contract is a leasing agreement. Let's start by analyzing the agreement for an identified asset. In this scenario, most likely the stadium is specified in the contract. So yes, the identification requirement is met. Next, does the purchaser direct the use of the stadium? Do they say when, how, or where? The answer here is likely no. The purchaser of the stadium naming rights does not direct the use or manage operations of the stadium. They simply pay for the right to have their name displayed. As a result, most stadium naming right contracts do not contain a lease. Now let's talk about embedded leases. An embedded lease is a lease within a contract that may not be called a lease. Embedded leases meet the same criteria as a lease under ASC 842. However, it's not always clear the contract meets the criteria of a lease. With an embedded lease, you're typically talking about a contract where the primary transaction isn't necessarily the lease of an asset, but the terms of the arrangement actually convey the customer a right to control a specific underlying asset. Common examples can be service contracts or supply agreements. Think of a supply contract where you pay for the supplies consumed, but they're dispensed from some type of equipment like a vending machine or an automated dispensing machine for money. If the dispensing machine is provided by the supplier, an embedded lease may exist. Embedded leases aren't new. They've been around for a while, and companies were required to identify them even under ASC 840. However, they're getting greater scrutiny and consideration now because of the new requirement to present operating leases on the balance sheet. In the past, since operating leases were off-balance sheet arrangements, not identifying all embedded leases did not pose a material risk to the accuracy of the financial statements. Companies should consider their policies and processes around reviewing contracts for embedded leases and make sure they're robust enough to comply with ASC 842 requirements. The second example in the Ultimate Accounting Guide is how to identify an embedded lease. Company A has a security services contract with ABC Security. ABC Security provides cameras, monitors, and keypads for Company A's facilities. The contract states that Company A will have full usage of ABC Security's monitoring equipment. The contract lists each item along with an identification number to be used for this service. Company A will have full control over the monitoring equipment and will obtain substantially all of the economic benefits of the security equipment. The same questions apply for identifying an embedded lease. Are the underlying assets specifically identified? Yes. The cameras, monitors, and keypads are listed in the contract along with identification numbers. Does Company A have control of the underlying assets? Yes. The contract grants Company A full control over the monitoring equipment. And lastly, does Company A obtain substantially all of the economic benefits of their underlying assets? Yes, the contract grants Company A substantially all of the economic benefits of the security equipment. Therefore, in conclusion, the equipment portion of this contract meets all the standards required for an embedded lease. The last piece we'll look at for identifying a lease is scope. ASC 842 applies to most leases and subleases, but exceptions do exist. Certain types of leased assets are not in the scope of ASC 842 because they are covered by other FASB guidance. This table, also found in the Ultimate Lease Accounting Guide, shows all of the lease types that do not fall under the scope of ASC 842 as detailed in subtopic 842-10-15-1. Those are intangible assets, rights to explore for or use minerals, oil, natural gas, and other similar non-regenerative resources, biological assets including timber, inventory, and assets under construction. If the lease agreement is for one of these types of assets, it is not accounted for under ASC 842, but rather accounted for under other more appropriate guidance.